This presentation is intended to help you better visualize the schedule of cost of goods manufactured through the use of boxes. Boxes can have something in them to begin with, a beginning balance. You can add items to a box. In addition, you can remove items from a box, and you can have items left in a box. Visualize your bank account as a box. You have a beginning balance. You make additions or deposits. You make withdrawals, or you write checks, and hopefully have a positive ending balance. Let's take a look at an example with some numbers. Let's assume we have a beginning balance of $500. If we deposit $2,000 and write checks for $2,300, we will be left with $200 in our account. A key feature of our visualization with boxes is that the left-hand side of the box must equal the right-hand side of the box. Notice the $2,500 on both sides. Consider another familiar box, the statement of retained earnings. Beginning retained earnings plus net income minus dividends equals ending retained earnings. Again, let's take a look at an example with numbers. Beginning retained earnings is $1,000. The company earns $3,600 in net income. This brings the total on the left-hand side of the box to $4,600. If the company pays $1,600 in dividends, the ending retained earnings balance will have to be $3,000. And again, the left-hand side and the right-hand side of our boxes must equal. Let's take a look at the schedule of cost of goods manufactured. While it looks fairly complex, we can quickly visualize three separate boxes: a box for raw materials, a box for work in process, and a box for finished goods. Now let's take a look at each one of these boxes individually. The raw materials inventory box is comprised of beginning raw materials inventory plus purchases, less raw materials used in production, and an ending balance for raw materials. Notice that raw materials used in production consists of both direct and indirect materials. Recall that direct materials are issued to work in process, while indirect materials are charged to manufacturing overhead. Let's take a look at an example with numbers. Beginning raw materials is $1,000. The company makes purchases of $3,600. This brings the total on the left-hand side of the box to $4,600. If the company uses $4,000 of materials in production, then ending raw materials will have a balance of $600. Again, the left-hand side of the box equals the right-hand side of the box. The work in process inventory box is comprised of beginning work in process plus manufacturing costs less costs of goods manufactured and an ending work in process balance. Notice that the manufacturing costs or costs added to production during a period include direct materials, direct labor, and manufacturing overhead. The cost of goods manufactured is transferred to finished goods. And again, the left-hand side of the box will equal the right-hand side of our box. Finished goods inventory box is comprised of a beginning finished goods balance plus the cost of goods manufactured less the cost of goods sold and an ending finished goods balance. Notice that the cost of goods manufactured is transferred in from work in process, and the cost of goods sold is transferred out to the income statement. The costs of manufactured products is matched as an expense with revenues in the period in which they are sold. An advantage to thinking in terms of boxes is their similarity to T accounts. Notice that additions to our boxes appeared on the left-hand side, which is similar to the debit required to record a purchase or an addition to an asset account in our T account. Likewise, withdrawals from a box are made on the right-hand side, which is the same side as a credit journal entry when posted to a T account.